Everybody, and welcome to this week's webinar, which is called Keeping on Top of Business Cashflow. The webinar will be presented today by Tarryn Valle, who has presented with us before. It was fantastic. It was actually not so long ago, and the feedback was brilliant. So we're really excited to bring her back. Tarryn graduated with a Bachelor of Science majoring in Physics and Astrophysics in 1999. And a Bachelor of Commerce in Accounting in 2001. She attained the CFA designation in 2004 and the FRM designation in 2005. In 2015, she graduated with a Masters of Commerce in Finance from the University of Cape Town. She's actually coming to us from South Africa, as far as I'm aware, today. I think without further ado, I can pass things on to Tarryn.
Great, James. Thanks very much for the introduction. Yes, I am indeed in Cape Town, South Africa. And yes, I did go to the beach over the weekend, which is what most people want to know. So sorry for all of you who are in a cold Northern Hemisphere room at the moment. But hopefully we can shed some light on business cash flow. We all know that the concept of cash is king, and that certainly does apply to the management of a business. And today's webinar is really focused on perhaps, I'd say, small and medium enterprises, so self-employed, small business, and particularly those businesses that carry inventory. And we'll go into what that means and what that means for the business and how they should be looking after that. But it's a kind of an inventory-based business that we're talking about this evening. So maybe you're selling T-shirts or cars or any kind of machinery. This will be of interest to you. So let's kick off. Right, so what are our objectives for this evening? Well, what we're really trying to do is understand the business cash flow cycle. And when we talk about the business cash flow cycle, what we're really talking about is working capital. And we'll get into what that means. And the components of working capital are debtors and creditors and inventory, and we can compute metrics around these measures, around debtors, around creditors, around inventory, to start getting a sense of the cash flow cycle and the working capital cycle of our business. So the first thing we're going to do is, because accounting is perhaps not a subject that most people encounter on a daily basis, perhaps it's best left to bookkeepers in the back office, but what we're going to do is just go through a little glossary of terms so that we know that we're all talking about the same thing. I'm also aware that dependent on your accounting jurisdiction, you may call things a slightly different term, so let's make sure that we cover all the potential jargon, and if at any point there's any questions that you'd like to ask, please do feel free to put those in the chat forum or the window or email through, and James will jump in and let me know that somebody's got a question on hand. So we've got a concept of current assets. Now these are things that they belong to us as the around those assets, and it means that we can convert them to cash in typically less than 12 months. So things that would be current assets are cash itself, things like inventory, things like debtors, which we'll get onto in a sec. These would all be current assets. We can readily turn them into cash. Now the flip side of a current asset is really a current liability, and we owe these amounts. But again, the current part of it tells us that they're payable in less than 12 months. So this could be something like a bank overdraft or suppliers that we owe. So it's not going to be something like a long-term loan or a mortgage over a property. This is more sort of recent, that they need to be tackled within this financial year. Now we come on to the concept of inventory, and some people may know this as stock, but really what it is the product that we as a business sell to our customers. And again, as I mentioned, it could be anything. It could be bookshelves, it could be furniture, it could be television sets, it could be t-shirts, it could be jeans, shoes, whatever it may be. This is our product. We want our customers to buy this product from us. Our customers may not be the end consumer. We may be a wholesale business, so we supply retail stores, but we would still supply them with inventory, with product. We may also be in a situation where we manufacture that product ourselves. So we make the inventory from raw materials. Right, then we've got this concept of debtors, and some people may know it as accounts receivable. Personally, I think accounts receivable is almost easier to conceive of because it is to be received by us. It is receivable. So these are our customers to whom we have sold goods, but they haven't yet paid for those goods. They've bought them on credit. Now, we may, as customers ourselves, we may do this all the time. We may have a store card for a big retail chain, and we go in and we purchase goods off that card, and we know we haven't paid for them yet, and at the end of the month, we understand what we need to settle with the store. So these are customers who are buying our inventory from us, but they're not paying us yet. They will do so in the future. Now, we also, as a business, have people who supply us with goods. They may supply us with raw materials, or they may supply us with finished goods. But when we call them creditors or accounts payable, so to be paid in the future, it is payable, it means that we have bought goods from them on credit. We have not yet paid them, but we will do so in the future. So now we come to a concept of working capital. Now there's two parts to this. One is the definition of working capital itself, which really in accounting terms just means current assets, so everything that we own, less our current liabilities, everything that we owe. So that gives us a sense of what our net position is on a current basis. That is working capital. But then when we talk about working capital management, it's then how we manage the things that fall into working capital, how we manage our current assets, how we manage our current liabilities. Yes?
Sorry to interrupt. Your screen doesn't seem to be moving on from the first slide.
Oh dear. Okay. Sorry, we were on a glossary slide there. Is anybody, can you see that now?
No.
Okay. What I've done is actually turned it off, and I'm going to turn it on again, and hopefully that's
great. That's fantastic. So I can see the first slide. Try.
Are we still looking at just a title slide, or?
Yes, at the moment.
Oh dear. Okay.
Title.
Right. Sorry, everybody. Thanks for jumping in. Let me see if I can sort this out.
It's all right.
Okay, what I'm going to do is actually take it out of the kind of presentation mode, because I think that might be, yeah, okay, sorry about that, everybody. I think the presentation mode in PowerPoint somehow
okay, great, no problem.
Wasn't okay. So thanks for jumping in. I'm going to leave it out of presentation mode, so apologies for seeing all this sort of nasty bits of PowerPoint on the side, but I think that's probably the safer option here.
That's all right. Everything's still legible, so no problem there.
Fantastic. Thanks, James.
Sorry about that.
All right. So what? No. Great stuff. So what we were doing is working through this glossary of terms here, and we'd spoken about current assets and current liabilities and inventory, and then spoken about debtors, which can be known as accounts receivable, or creditors, which are also called accounts payable. And we touched on working capital, which as a definition itself is just our current assets less our current liabilities to give us some sort of net position of where we are. And then when we deal with working capital management, this is the management of our inventory, of our debtors, of our creditors, and how these things interact within our business to give us our cash flow cycle. So let's flick on to the next page. Okay. Sorry, I've got a few scribbles left behind. There we go. All right, so when we talk about our cash flow cycle, we can actually break this into two bits. We've got an operating cycle. And that's really our inventory in, and then our inventory out, and our collection from debtors. Now recall that debtors are our customers who owe us money. So at some point they're going to pay, and we call that our operating cycle. When we add in an extra step, and the extra step is when we pay our suppliers, then we start talking about what is known as a cash flow cycle, could also be called a cash conversion cycle, or alternatively a working capital cycle. These terms are all interchangeable. And that's what we're going to look at, is how we effectively turn our inventory into cash, and how we have to collect from the people who owe us money and pay the people who we owe money to. Let's see how we get on with that. So I guess the important thing is, yeah, we all understand cash is important and the management of cash is important, but why do we manage working capital? And particularly in businesses where the components of working capital make up a large portion of our balance sheet, so it's a large portion of essentially what the business is. Keeping track of all of these things is very important, because working capital management is actually the management of our short-term business investment and financing, because our business is investing in inventory to sell. Our business, slightly bizarrely, is actually also investing in debtors who will pay us money. And we are financing some of these activities through our creditors, through our suppliers, who we don't pay straight away. So if you think about, let's think about a large grocery store. Let's say they don't own their premises, they actually just rent. So that grocery store will carry a huge volume of inventory. So all their fresh produce, their tinned goods, their cereals, all of these kind of things. And we can imagine we walk into a grocery store almost every day and we see all of that. That would be their inventory. So in terms of what that business is about, what assets they have, well, a lot of their assets are tied up in their inventory. That is what they're investing in as a business. And now they may have to get in their dairy products and their fresh produce and their cereals and tins and whatever from various wholesale suppliers who ultimately they've got to pay one day, and they may sell all those goods to consumers like us, and we may pay for them on some sort of grocery store card. So we may purchase all of those stuff on credit to be paid for later. So in that instance, understanding your accounts receivable, the people who are going to pay you, understanding your inventory levels, understanding to whom you owe money is really the business. So it is the management of the business. And what we really need to make sure is that we have an adequate cash flow to keep funding our business operations. Because small and medium enterprises, SMEs, typically go bankrupt due to cash crunch. Obviously, there are other things like fraud and just really poor timing, poor luck, things go wrong. But when you look at bankruptcies and liquidations in the SME sector, most of the time it's because somehow a cash crunch occurred. The business couldn't pay the people who it owed money to, and they then put that business into liquidation or bankruptcy. So the management of this actually has real sort of impact on the viability of a business. And then more than that, it actually has impact on the profitability and the ROI, which stands for return on investment of the business. Because again, if our business is largely about the buying and selling of inventory, then we are using up our business resources, using up our business investment capability in this inventory. And so we've got to make sure that we're doing it in a profitable and efficient way. So knowing all of this, so understanding that these things are important, what sort of things do we need to keep track of? It's all good and well saying, oh, we must keep track of our inventory, we must keep track of our debtors, we must keep track of our creditors. How do we do this? Well, what we need to do is actually measure the time it takes to move through each segment of the cycle. So our number of days of inventory is actually the average time it takes us to create or buy, because we might manufacture it ourselves, to buy the inventory in and then to get it back out the door again. Okay, so that is the number of days that we typically have inventory on our shelves for. And obviously different businesses will tend to have a different number. If you're selling perishable goods, then you better turn your inventory over really fast. You know, if you've got dairy products, the number of days of inventory you need to have is probably 1 or 2, because beyond that you're writing off your stock. Now, let's think about the number of days of receivables. Well, that is the average time it takes to collect from somebody who owes us money. So we make the sale to them, they haven't paid us yet, and then we need to keep track of how long it takes us to get hold of that money. And then we've got a concept of our number of days payable, and that's the average time it takes us to pay our suppliers. So we've purchased some goods from them, we haven't paid them yet. How long does it take us to pay? And by having these 3 metrics, inventory days, receivables days, and payables days, we can put them together to get a cash conversion cycle. And we'll go into this in a little bit more detail in a sec. But essentially it's our inventory days plus our receivables days minus our number of days payables. And we'll go through an example and see how that might all work. So let's look at a really simple example, and perhaps this will sort of illustrate some of the points. So let's assume that on the 1st of January, we purchased $500 worth of t-shirts from our suppliers. And the supplier said to us we had to pay a 50% deposit in cash, and we owe the supplier the remaining $250. So from a cash perspective, what has happened? Well, from a cash perspective, the first $250 went out the door, and that's gone. And we know we still owe the supplier a further $250. And then let's assume that the t-shirts are now sitting on our shelf, and on the 15th of January, a customer comes in and says he loves the whole lot, he's going to buy every t-shirt for his corporate team, and he wants to buy $500 worth of t-shirts, so our whole stock. But he doesn't want to pay for them now in cash. He wants to buy them on credit, and he'll pay for them in 30 days. So what has happened in this situation? Well, we've got a sale, which is fantastic. So everybody would be excited by that. Yay, sale. We've moved our inventory. We've moved our inventory quickly. Have we got the cash? Not yet. The cash is still to come. So we would have noted the sale, and we would have noted the fact that we now have a debtor or an accounts receivable, somebody who owes us money. But from a pure cash perspective, it's a big fat 0. Now, let's roll forward a little bit further and say, well, now on the 31st of January, our supplier, from whom we purchased all our t-shirts up here, says, you only paid your 50% deposit, now you owe me for the balance. So we owe the supplier another $250. But have we collected any cash? No, we haven't. Now, what would happen if we now also had additional operating expenses we needed to pay on the 31st of January? We had rent due, we had our shop assistant that we needed to pay a salary to, we had our telephone coming due. So what has happened is that on the surface, it looks like we've had a great month. We sold $500 worth of inventory. All our inventory's gone. But from a cash perspective, we're in trouble, because we don't have cash to pay our creditor and to pay our outstanding obligations, because the person who bought from us has not yet paid us. So we sold our inventory quickly in 15 days, but we didn't collect the cash proceeds of sale. And now we need to pay our supplier before we've collected the cash from the sales. And this is what we term a cash flow crunch. So it's not that the business isn't operating as it should. It is. It's doing a good job of selling t-shirts. But because we haven't managed our cash flow correctly, we're going to have an angry supplier because we don't have the cash to pay him. Now, this is obviously a very simple example, but hopefully it's one that illustrates how quickly a business that is generating sales and generating revenue may not be generating cash fast enough, and why then the management of that cash cycle becomes quite critical. Are there any questions from anyone at this point? Okay, all good. Right, so knowing that we have to keep track of our number of days of inventory and our number of days of receivables and our number of days of payables, how do we actually do this? Well, this is when it becomes a little bit more numerical. So don't be put off by formulas. What goes into the formulas is fairly straightforward. And if you were a business owner, you would likely have all this information available to you to be able to do these computations. So when we're talking about our number of days of inventory, what we've got is a bit of a fraction going on here. So to work this out, we have to divide our inventory number in dollars or pounds or euros or whatever the appropriate currency denomination is, and we have to divide it through by our cost of goods sold. Now, cost of goods sold is really just an accounting term for what did we pay for the inventory. So let's say we are the t-shirt business and we bought t-shirts from our supplier. Well, we paid $500 for our t-shirts. And what is our inventory worth? Well, we would have a number there as well. And what we have to do is multiply it through by the number of days per period. Now, what do I mean by that? Well, if we're talking about annual data, so let's say we've got our year-end financial statements and we want to do this exercise. How many days are there in that annual period? Well, 365. If we were working with monthly management accounts, which quite often we would get as a business, how many days are there in that monthly period? Approximately 30. So we would change that time factor dependent on whether we were working with annual data or monthly data. So we've got our number of days of inventory, which is our inventory divided by our cost of goods sold. Then we've got our number of days of receivables. Now, receivables, that's people to whom we have sold our goods, but who haven't yet paid for them. And receivables are a current asset because that money is to come into the business and we own that money, but it hasn't arrived yet. And we divide our receivables by our credit sales. Now, quite often a business may not break out their normal cash sales from their credit sales, in which case we could just use the whole sales number. And you can see here I've used sales, and down here I've used revenue. Revenue and sales are largely interchangeable terms, and again, dependent on where you sit from an accounting perspective, you may be more familiar with using the word sales, or you may be more familiar with using the word revenue. So our number of days of receivables are our receivables divided by ideally our credit sales, but if not credit sales, then just our sales. And then we've got our number of days of payables. So payables, people to whom we owe money, we have bought from them on credit, and we would divide our accounts payable, so the total that we owe, and we would divide that through by our revenue or sales again. And again, in each instance, we're multiplying by the appropriate days per period. Okay, so those formulas are fairly straightforward, and we should be able to find them fairly easily off our management accounts or our annual financial statements. And then what do we do once we've got those numbers? Well, what we do is then a fairly simple sum. We add our days of inventory to our days of receivables, and we subtract our days of payables, and that gives us our cash conversion days. This part, if we remember from upfront, is our operating cycle. When we put it all together, this is our cash flow cycle, the whole lot. And the best thing to do now is to actually look at some examples and see if we can work these things out ourselves and then see what they tell us about how the business is being managed. So let's assume we've got three companies. We've got alpha, beta, and gamma. And we don't really know what they're doing, but we've got a sample of their balance sheets. Now, just for those of you that aren't familiar with what a balance sheet is, at quarter end or financial year end, what we will do is essentially put together a list of all our assets and liabilities and the equity in the business. And this is really just a snapshot of the financial position of the business. All the things we own, all the things we owe, and what gets left over, and that's the equity that's left over. That's sort of what the business owner's stake in the business is. So we've got a balance sheet here for alpha, beta, and gamma, and let's have a look at some of the key items on here. So we're focused on working capital management, and working capital management speaks to the current assets and the current liability sections of our balance sheet, and specifically to our inventory and to our accounts receivable and to our accounts payable. And again, accounts receivable, we may call it debtors, and accounts payable, we may call that creditors. And that's the bit that we're working and looking at. So we've got these metrics for alpha, beta, and gamma, but now we know that when we looked at our days payable and our inventory days and our days receivable, we actually also needed some information from our income statement. So let's have a look at some sample income statements for alpha, beta, and gamma. Now again, an income statement really tells you what your sales were, what your cost of sales were, what your operating expenses were, and the result, the net result of those things is your net profit after tax. And an income statement gives you that information over a period. So if we're looking at annual financial statements, it'll be over the year, how much revenue did we make? Over the year, what were our total operating expenses? As opposed to a balance sheet, which is more of a snapshot in time. So this is a sample income statement for our companies, alpha, beta, and gamma, and we can see they all made plenty of revenue. There it is. They all had obviously a cost of selling their goods. There are those cost of goods, and that's something that we will need in our formulas. And we don't have a breakout between revenue from cash and revenue from credit, and that's okay. We can just use the revenue line item. So now what we're going to do is, having pulled some information off the balance sheet from the current asset and the current liability section, and having reviewed some of the line items from our income statement, our revenue, and our cost of goods sold, we're going to have a look at computing some of the metrics to work out our cash flow cycle. And that's what we're doing across here. Now here's just a simple way of writing out that formula. And you can see here I've put here AVE, which is really average. And if we were being really pedantic about this, we wouldn't use our inventory value at the period end. We'd use some sort of average value over the year. Because as we know, our inventory could fluctuate across the year, and in some months of the year we may have lots of inventory, and when it comes to financial year end, maybe we've sold a lot of it and our inventory level's low. So we would typically use an average measure, and if you were looking at monthly accounts, perhaps you would use an average over the quarter and you'd get a sense of what was happening on a quarter by quarter basis. But if we don't have average, then we can just use the year end or the period end values, and that's what we're going to do. So our number of days inventory is our inventory divided by our cost of goods sold multiplied by 365, because we're looking at annual data and there's 365 days per year. And we've pulled these numbers off the balance sheet and off the income statement for alpha, beta, and gamma. And let's have a look at what these numbers tell us about the business. So in terms of alpha, we have a number of days inventory of about 90. In terms of beta, we've got a number of days inventory of nearly a year, 338 days. And for gamma, we've got number of days inventory of 56 days. And just remember what number of days inventory means. It's the amount of time it takes from the inventory arriving in our warehouse, at our shop, at our factory, to the inventory being sold, so leaving our possession. So for all these days, 90 days in the case of alpha, 338 days in the case of beta, we had that inventory for that length of time. So it really is a number of days. And we do the same thing for accounts receivable. So it's our debtors or our accounts receivable divided by our credit sales, if we can break out that data, otherwise just by our total sales or revenue. And we get a number of days again for alpha, beta, and gamma. And again, 59 days in the case of alpha. It means that from the point of sale to a debtor, so a customer who's walked in who said, I want your stock, but I'm not going to pay you yet. In the case of alpha, it takes them 60 days from the sale to collect the money. In the case of beta, it takes them 81 days from the sale to collect the money. And for gamma, it's about 37 days from the sale to collect the money. So these again are number of days. Then we look at our accounts payable days, which is our creditors or our accounts payable. These are our suppliers that we've got goods from on credit, and we divide through by our cost of goods sold and multiply by 365 days per year. And we can see that for alpha, the number of days that it takes us from receiving the goods from our supplier to actually paying them is about 61 days. We look at beta and we say, well, we've received our goods and it took us an unbelievably long period of time to actually pay for them. It took us 415 days to pay for our goods. And then we look at gamma and we've got about 66 days it's taking us for the inventory to arrive from our supplier to the time that the cash leaves our bank account and goes to settle that invoice. So when we look at our operating cycle, which is our number of days inventory plus our accounts receivable days, we get some measures for all three companies, alpha, beta, and gamma. And we go one step further and we subtract our accounts payable days from our operating cycle to get our cash conversion cycle or our working capital cycle or cash to cash cycle. Here we called a number of things. And now this gives us a really interesting picture, because what we can see is that for alpha, it takes 88 days to go from cash to cash. And that's quite a long period of time. Then we look at beta and we say, well, it only takes 7 days. Now that seems bizarre because beta had inventory on its books for 338 days. And then it took 81 days for the people that had bought its inventory to pay for it. But the real trick that beta's got going on here is this accounts payable days. It's taking beta 415 days to pay its suppliers. Now, the type of industry that these metrics might apply to is it could be a high-end car dealership. So in this instance, let's say it's a BMW dealership. It's probably a brand we're all familiar with. And their inventory comes in, and the market's a bit slow for high-end cars, and the cars sit. There's their inventory. They sit for not quite a year, but in their showroom floor. And then eventually somebody comes to pay for them, and they say, okay, well, you've got 3 months to pay, and by and large, within 81 days, which is more or less 3 months, the customer has paid for that car. But because they're a BMW dealership, they've got great terms with the BMW head office, and it takes them, they say, okay, well, we won't pay for the car all the time that it's sitting on our showroom floor. We'll only pay for it when we have sold it and we've collected the money. And so that's why, on a cash-to-cash basis, beta is actually doing a great job, despite the fact that its inventory is very slow moving, because it's not having to pay for goods ahead of receiving its money. Now, when we look at alpha and we say, well, alpha inventory, 90 days, maybe that's something like a computer store. Every 3 months, it's going to turn over its inventory. Alpha is taking quite a while to collect on that sale relative to the payment terms it's got with its suppliers. So as a result, Alpha's cash-to-cash cycle is really long. Now, quite bizarrely, you can actually get a business with a negative cash conversion cycle. In other words, it's turning over its inventory, it's collecting from its customers very quickly, and then it's taking a long time to pay its suppliers. And so that business is doing a really great job of ensuring that that cash flow is really quick. So if you get a negative number there, don't be alarmed. It means that your Anybody have some kind of personal examples that they want to perhaps discuss?
Hi, Tarryn. We'll keep an eye on that, and if anybody comes in with one, I shall let you know.
Okay, great stuff. Okay, so having gone through those metrics, what can we tell in terms of business cash flow management? What is our ideal scenario? Well, our ideal scenario is actually to turn over our inventory quickly. So what does this mean? It means that don't take in more stock than is absolutely the kind of minimum level to be able to supply your customers appropriately. But what you don't want is inventory sitting in your warehouse. Because when inventory is sitting in your warehouse, it's effectively using up your business resources. You've invested in all this inventory, and now it's sitting not being converted to cash. So certain businesses obviously lend themselves to a high inventory turnover. So again, a business selling perishable goods has to turn over their inventory quickly. Otherwise, they've got to just write off that stock. But dependent on your business, let's say you are a computer supplier, what you want to make sure is that your inventory levels are just right. And that may take some finessing to get to that point, because what you don't want is customers coming in and wanting to buy a particular model of computer and you don't have it in stock. That's a lost sale. But equally, you don't want to have so many computers in stock that you've paid for, that you haven't turned into sales and you haven't collected on, that when something else happens, you cannot take advantage of that. You've got no cash resource to maybe go and open up an additional store, because all the cash and all the business resources are sitting locked up in your inventory. So we want to be in a situation where we manage our inventory levels very efficiently, and ideally we turn over our inventory as quickly as possible. So we want it in and out fast. Then what we want is to be able to collect our cash from our debtors quickly. Now again, there's a balancing act here, because what you will find is that a lot of businesses will have really generous credit terms. So they want to make the sales. So you can have what is known as a relaxed or lax credit policy. In other words, anybody that turns up, you say, hey, don't worry, have a store card. You can buy £500 worth. You only have to pay for it in 2 months' time. So that would be a lax credit policy. We are more focused on making the sale than we are worried about being able to collect from those customers. So again, there's a balancing act to be had. But ideally, what we want to do is to be able to collect from our debtors quickly. And that would mean that the people that we're extending credit to, allowing to buy our stock without paying for it, we've got to be pretty sure they will ultimately pay. because with a lax credit policy, what tends to happen is we get this boost in sales because everybody says, hey, you can turn up at that store, get a store card, take a whole lot of goods, and you don't have to pay for them for 60 days, or maybe never if I'm an unscrupulous customer. So we need to get this balancing act correct by giving our customers enough credit to entice them into our store, but also making sure that we can collect from them quickly. And some of the incentives to collect quickly may be giving a discount for early payment. And it may actually be more beneficial to give a debtor a settlement discount. So pay us quickly and you can get 10% off what you owe us, because what that means is the cash is back in our hands to be deployed within our business. So we want to collect cash from our debtors quickly. Then what we want to do, and again, balancing act required, is we actually want to pay our suppliers slowly. When we pay our suppliers slowly, we are actually financing our business through our suppliers. Our suppliers are extending short-term financing to us. So if you are a business and you have a supplier that you buy from often and you pay often and you've got a good relationship with him, it's actually incumbent on you from a working capital management perspective to go to that supplier and negotiate better terms. Say, you know what, I don't want to pay you every 15 days, I want to pay you every 30 days. Or I want a discount if I'm going to pay you early. You've got to make it worth my while to hand over my cash, because cash is precious to me in my business. So if you have suppliers, try as best as possible to extend those terms. And if you can't extend those terms, really try to get a discount for early payment. It's got to be worth the while, and you've got to have shown that you are a good customer, that it's worth them keeping you happy. So by doing these things, by turning over our inventory quickly, by collecting quickly from our debtors, which means making sure that our debtors are in fact appropriate and will in fact pay us, and by sometimes employing staff to chase debtors, and that's really what a debtors team will do, is phone up the people that owe us money and try as best as possible to recover it, and try and incentivize debtors to pay through discounts. We're ensuring that our cash cycle is minimized, and in an ideal scenario, our cash to cash number, which is our inventory days plus our receivables days less our payables days, may turn out to be a negative number, in which case that's the sort of holy grail of cash flow management, and we're doing a great job. And that brings me to the end of what I was going to deal with tonight, and perhaps that gives us 15 odd minutes for any questions if they've come up. James.
Hi, Tarryn. Actually, Sydney is going to take the questions today. So as soon as those come in, she will be taking over from me to ask any questions that people may have. Yeah, just really like to encourage everybody, while you have the chance, to take this opportunity to ask Tarryn anything that you'd like.
Thanks, James. Thanks, Sydney. I do understand that accounting can sometimes be a bit of a daunting topic for people, particularly if this is not something that they do on a day-to-day basis. But please be assured there are no silly questions. If something's bothering you within your business process, I'm only too happy to have a chat about it.
Somebody has asked a question to us, really. That's James Murphy. Do we receive a copy? Actually, it's Tarryn also. Do we receive a copy of the slides, and if yes, how? In terms of the recording of the webinar, we look to get that uploaded and sent out to people who attended, and even those who just registered, within 48 hours. regarding the slides, I'm not sure. Tarryn, is that something that could be made possible, or?
Yeah, sure. If that would be helpful. The best thing for me to do is to email that across to you, James, and let you distribute it to whoever's keen.
Perfect. Yeah, I can do that. So yeah, James, and for anybody else who wants them, they will be there. They'll be sent out probably, if not tomorrow, the following day. So thanks, James. And then I will let Sydney take over, as there is a question now.
So Ivan says COGS.
I'm not sure that I heard you there, Sydney. No.
Yeah, Sydney, I know from my side that was you sort of cut in and out there.
Okay. I tell you what, I'll ask this one, just on the basis that the audio equipment seems to be suffering. So Ivan said, wouldn't it be more meaningful to use credit purchase in the payable days instead of COGS?
Yeah, let's go and have a look at that. See if I can get back. Yeah, sorry. I think what I've done is made a mistake in my final slide over here. Thanks for pointing that out, Ivan. That is, in fact, incorrect there. And what I'll do is correct that ahead of it being distributed out. If we jump back here and have a look at our formula, what we should have done is used our credit sales or our revenue. And again, we could, the absolute best is to use credit sales. You're absolutely correct. But if we don't have credit sales, we could just use revenue. So apologies, there was a glitch in the matrix in our final slide there. Thanks for spotting that.
So Carla says, I didn't quite understand why you said customer beta was doing well. Could you go over that again?
Sorry, Sydney, would you mind just repeating that? I missed the last bit there.
So she said, I didn't quite understand why you said customer beta was doing well. Could you go over that again?
Yes, sure. Let's go and have a look. Yeah. Okay, so our basis for determining whether a company is doing well or not is this concept of cash conversion cycle. And perhaps what I should say there is that the lower the number, the better it is, because this is really a number of days that it takes us to go from cash to cash. So in this instance, customer beta takes just under 4 days to go from a cash position to another cash position. And when we would first look at that data, we wouldn't perhaps understand how that's happening. But because, as we can see here, there are a number of days inventory, which means how many days is there between the inventory arriving within their warehouse to the inventory being sold and leaving the warehouse. That looks like a really long period, 338 days. And we think, well, jeepers, you're sitting on your stock for a really long period of time. And then when we look at our accounts receivable days here, we've got 81 days. We say, well, now you've sold your stock, but it's still taking you 81 days to now collect the payment. So from the point at which the inventory or the stock leaves our store and our customers purchased it, it takes the customer 81 days to pay us. But company beta can handle all of this because of its accounts payable days. And its accounts payable days is the length of time that it takes to pay its suppliers. And these things are all linked. So think about, let's assume that this is a car dealership. So the car arrives and the clock starts running. And 338 days later, the car is sold. and then the clock starts running again. And 81 days later, the customer who bought our car pays the cash. But from the point at which the car arrived, so became ours, we wait 415 days before paying our head office supplier. So what that means is that although we have had the stock sitting on our showroom floor for a very long time, and although it took us quite a while in order to get the proceeds of sale from our customer, we had really generous payment terms with our supplier. So we were under no pressure to pay them before we had received the money. There's just a very small gap there. So within effectively 4 days is our cash conversion cycle. So between collecting the money and having to pay our supplier is just 4 days. Does that make sense to you?
I think that's a very clear explanation. If there's a response from Carla, I'll be sure to let you know. Sydney has another question here in the meantime.
Okay, so Prit says, how do we know how many days we can hold on to goods? When companies sell items very cheap, is that because they're selling under cost to reduce the number of days holding stock?
Yeah, that's a great question. And quite often, yes, that is exactly what they're doing. So a lot of the times when, and the sort of high street retailers do this in particular, they have these massive clearance sales. And that is really because they've had stock that's sat on their showroom floor that they haven't been able to move. And so they would rather sell it at a discount and sometimes even at a loss than have those business resources tied up in that inventory. And if we think about a high street retail store in particular, fashion trends change all the time, and it's a very fast moving environment. So if you've got, and seasonal as well, so if you've got now a whole lot of winter stock and you're going into spring and summer, you want to get rid of that. So the best thing to do in that instance would actually be to really heavily discount your stock. Say, you know, our buying was wrong for that season. We had coats in brown and everybody wanted blue. Let's rather clear them from our stores, get that cash in, which we can then deploy into fresh seasonal stock.
Great. Yeah, I think that has entirely answered the question. And also, Carla just responded to say, yes, thank you. It seemed like a long time, but now she's clear about customer beta. So, yeah, that's perfect. And also thank you from Pritz as well. I think that
Great.
We'll probably look to wrap up in a moment unless any other questions come in. So thank you very much for that, Tarryn. It was brilliant. It was really, really good. Actually, one question I do have for everybody in the webinar, obviously you're joining us means that you have an interest in business cash flow or wider accounting. Please do just put in the questions box if there's something specific that you'd like Tarryn to look at in the future, or if there's something you'd really like to learn about. And because it's hugely helpful for us when we're deciding what these members' webinars will be about, if there's something that we get loud and clear from members. But yeah, sorry. So I went a little bit tangential there, but thank you very much, Tarryn, and that was absolutely brilliant. As I say, I'll distribute slides and everything rather in the coming days. There is one question, and I think that this may be the last one. First of all, Ivan says thanks to the whole team. Absolutely no problem. I really enjoy doing these, and I'm sure Tarryn and Sydney feel the same. But Chris Garland asked, isn't the profit critical to the cash conversion cycle? Because you have to make enough profit to cover the window.
That is a really good question, and I tell you why is because you can have this bizarre situation where you have profit but no cash. And I tell you how that works. let's assume that we make lots of sales, but they're all credit sales. So we haven't received any money. So we've lots of sales. Our operating expenses are pretty low. So when we work out profit, and in fact, I'm just going to go to our income statement slide so that we can look at this. Let me just remove some scribbling. So let's assume that all of this was credit sales. So we did $1 million worth of sales. We subtract our cost of goods sold, and we've got gross profit here. And then we subtract again our operating expenses, and we've got net operating profit, and we've got some interest expense and tax and all of these things. And we come out and we've got profit. And these numbers could be anything there, but the point is that the business makes a profit. But we could have a situation where, because all of our sales were credit sales, we haven't actually taken in any cash as a business. And when we don't take in cash, it starts becoming really difficult to pay for our expenses, because things like rent, like phones, like insurance, all need to be paid for in cash. So you can have this funny situation where your sales are far exceeding your expenses, but because your sales are not cash sales or don't have a cash component to them, or you haven't collected the cash from those sales, you run out of cash, even though you're a profitable business. And if you run out of cash, and the people that you owe money to, they have then the power to actually put you into liquidation or bankruptcy. And it can be heartbreaking, because your business is profitable, you're making sales, but because you haven't managed to collect in the cash, you can't then pay your suppliers, you can't pay your operating expenses, and your business goes under simply through poor cash management rather than poor business process and poor product.
Wow, that's a scary problem.
Sorry, that was the doom and gloom.
Yeah,
The doom
sure.
and gloom speech from Cape Town.
But I think that on that note, or on that bombshell, we'll call it a day. Though, I'd just quickly like to say thanks to Bisham, who has put a recommendation in for what he thinks that we should look into going forward. Any ideas that anybody has, or if they want to get in touch about anything to do with the webinar, please go ahead and email us. I say it every week, but just always like to echo it again. It's info@webinarsteam.com. That's info@webinarsteam.com. Yeah, and I think that with that, and also a very big thanks once again to Tarryn, but with that, we'll call that a day until next week.
Great. James, Sydney, thanks very much. Thanks for having me. It's been a pleasure. Look forward to speaking to you all again in the future.
Likewise. Yeah, thanks a lot. Have a nice week, everybody. Bye-bye.